our Garage Insurance Made Easy webinar. My name is Christina Cole, Chief Operating Officer here at CID Insurance. Before we get started, I just wanted to take a moment to introduce our panelists today. We have Ronaldo Figueroa on the line with Nationwide E&S Specialty. He's a garage underwriter. Teresa Cochran at CID Insurance, your garage underwriter, and myself. CID is proud to kick off 2018 with a series of monthly webinars. Garage is one of our most sought after products, so we thought this would be a great place for us to start. Today's session is geared toward understanding the differences between the garage and CGL coverage forms, identifying coverages that are unique to the garage form, and to assist you in identifying the right coverage for every garage risk that you're pursuing. Since there are so many participants, it is necessary for us to mute our audience. However, we do want to encourage everyone that has a question to please type it in the chat room at any time throughout the webinar. Teresa and I will be monitoring the questions and will interject with Ronaldo to make sure that all of your questions get answered before we end our session today. I'm going to turn the floor over to Ronaldo now, and we'll get into the meat and potatoes of why you've all joined us today. Ronaldo?
Well, again, thank you everyone for joining us today. My name is Ronaldo Figueroa, again, garage underwriter for Nationwide Insurance. Pretty passionate about the garage stuff, so very excited to be doing this today with you all. What we'll be going over today is just very high level training, garage training over the garage fundamentals. We like to call it the garage basics. So without further ado, we'll just kind of dive right in. I'm going to assume that most of you out there are familiar with a commercial general liability coverage form. So again, we're going to talk about the differences here. So the CGL form offers in coverage A, which you're familiar with, the bodily injury and property damage liability. Well, garage form also offers this same, but it's just captured in different wording. It's captured here in this garage operations other than covered autos. So that's going to be very similar to the coverages you're going to have in the in coverage A of the CGL form. Where the difference is the main difference is the garage form also offers garage operations for covered autos liability, whereas obviously the CGL form will exclude autos. So the key question when you're looking at a garage risk, is there auto exposure to this risk? If there is, chances are it's probably a good fit for a garage form. So we like to call the garage form the all-in-one approach for a variety of reasons, but mainly again that it provides the both premise and product liability coverage for similar to what a CGL form offers, but again has the key differentiator with the auto liability as well. We have the ability to add physical damage coverages for both your non-owned autos and your owned autos. So you're going to see more your non-owned autos for your service type risks, for your car washes, your general repair risks, valet risks. And then we also offer physical damage coverage for your owned autos, which is going to be mainly for your dealers for their inventoried autos that they have on their lot for sale. We can schedule autos on a garage form for, if they have a service use vehicle, you have a service risk with a service use like a parts running auto, we can schedule that. There's also additional coverages that can be purchased for an additional premium, of course, and we'll talk a little bit about that later on in a few slides. Garage liability. So the main purpose of this slide here is just to show you that the limits are going to look similar to what you're used to seeing on a CGL form, again, except for the top bullet there, which is the auto liability limit. So the exclusions, again, very similar to what you'll see on commercial general liability form. I would like to speak a little bit on a few that are probably you're not too familiar with. So as you see towards the bottom there, you'll see the least auto exclusion. So this is built-in exclusion into the coverage form. However, there is a loophole to this where if you have the coverage form gives back coverage, the exclusion will not apply. So the coverage form will give back the coverage in the event where if you have a repair risk that has a customer's vehicle in for repairs, and then they loan an auto back out to the customer while their vehicle's in for repairs. So in that event only, the coverage form will give coverage back. So the least exclusion will not apply. So therefore, it's just something to be aware of and underwrite around should the exposure exist. Another one you might not be too familiar with is the racing exclusion. We like to call that the total racing exclusion. Now this is going to exclude any auto that could be was in for repairs, being worked on in preparation for a contest or a racing event, or even a motorcycle that was sold by a motorcycle dealer that was used in a motocross or some type of competition. So total racing exclusion, just again something to be aware of. If you're looking at, again, a lot of times you'll see this in the exposure exists when you're looking at motorcycle repair shops or a high performance repair shop, that type of risk. The work you perform, the exclusion is going to be similar to a CGL form, though. That's going to be, if you have a repair shop that did some repair on, let's say they worked on the brakes. So anything they actually wrenched on is excluded, but all the resulting damages to the loss would be covered. Garage liability endorsements. So these are the additional coverages that can be purchased for an additional premium, of course. Broadened coverage, which encompasses all that you see there below it. And then over to the right side, you'll see we offer uninsured and underinsured motorist coverages. Personal injury protection. Now that's going to be state specific. Certain states require it, so of course we offer in those states that require it. Your auto dealer's E&O coverage, so that's going to include your truth in lending E&O, your title E&O, federal odometer E&O, and your false pretense coverage. Now, false pretense is an exclusion, however, or it's a coverage that can be bought back. It's actually an exclusion, but it's a coverage that can be bought back. And then MedPay can be purchased on a premise or auto, or you can purchase them both on a combined basis. Garagekeepers Coverage. So this is going to be your physical damage coverage for a non-owned auto while it's in our insured's care, custody, and control, just like you see there. So this is going to be mainly for your service risks when they have your repair shops or your a valet risk or a car wash. While they have a non-owned auto in their possession, it's going to be the physical damage coverage for it. So it can be written in two different ways: a legal liability basis or direct primary basis. So legal liability is kind of just what it sounds like. It's going to be if a loss were to occur to the auto, well, again, in our insured's care, custody, and control, our claims department will get this. They're going to do a full investigation on it, and they're going to determine whether or not the insured was legally liable. So were they negligent in any way for the resulting damages? If they were, then they'll pay for the losses. The direct primary is, again, what it sounds like. There's much more exposure involved with it. If the auto, while the auto's in our insured's care, custody, and control, if it's damaged in any way, there's really no investigation that goes into it. If it's in our possession, we're on the hook for the damages. So as you can see, there's much more exposure involved with that. So it comes with an additional premium. So there's obviously a higher rate for direct primary. One thing that you do want to watch out for, now I know most of you guys are probably based in California, but one thing to watch out for is hail, some weather exposures with direct primary. Again, no real investigation goes into it. If a vehicle's in our insured's care, custody, control and it's damaged by hail, well, we're going to pay for that. Whereas if it was legal liability, hail is considered an act of God, so we wouldn't be negligent in any way for those damages. So again, just you can see the added exposure that goes along with the direct primary.
And I think that for anyone out selling the garage product, for the additional premium that is charged on the direct primary, it's really insignificant to what a potential loss could be. So I highly recommend that if you're working with a new prospect, that the direct primary is coverage that you would automatically opt for. And just protecting yourself and your insured, it's the best option for everyone.
Yeah, that's a good point. And also, I guess I should point out too that the direct primary legal liability, whereas theft also an exposure to be careful. So how the autos are protected when offering direct primary versus legal liability, because again, legal liability, if our insured has done everything in their control to protect that auto, so if they've had it inside their bay and the bay is alarmed and someone breaks into the bay, steals the car before the police can respond, well, our insured was a victim in that matter too, so most cases that claim would be denied, whereas in direct primary, we'd be on the hook for it. So again, just something to be done to right around. So yes, garage keepers, it can be written probably similar to what you have in your personal auto, either comprehensive or collision, or specified causes of loss in collision. Well, as you can see there, comprehensive in collision is also known as full coverage. There's no real gaps in coverage, as you can see there, because comprehensive is anything except your collision or overturn, and then collision picks up that gap. Whereas specified cause of loss, you can see that it's only those specified perils there that it's covered. So it's less exposure, very limited coverage there. So it's just something to know and make sure that the insured is aware of what's being covered there. Exclusions for your garage keepers coverage. I won't spend much time on this. Now, the one that's a little tricky is just theft there. Now, that's actually just, the exclusion applies to theft of like if the insured caused the theft or an employee, so that's excluded. And again, the other one's your faulty work. It's going to be very similar to your, resulting damages would be paid for, not what our insured wrenched on, that type of thing. Okay, physical damage coverage. So this is different from your garage keepers because this is going to be for your owned autos. So this is also known as dealer's open lot or DOL coverage. So this is going to be for your dealers who have, their inventoried autos that they have on the lot for sale. Again, this can be written on a comprehensive or specified cause of loss and collision basis. So it's going to be one of these two and collision. So, but you can see here though the specified cause of loss has additional perils that the garage keepers did not, and mainly it's the weather, the weather peril. So you're going to see the windstorm, hail, and earthquake and flood here versus back here on the garage keepers it's not. So again, some added exposure, but still limited compared to the comprehensive where there's still gaps in coverage. So just something that the insured needs to know what's being covered there and what's not in that case if they elect to go for specified cause of loss.
And again, everybody, we really recommend doing comp and collision, not the specified cause of loss. There's really not a big difference in premium.
That's correct. I would agree with that. And then, yes, so the physical damage coverage, these exclusions, again, this is similar to what you saw on the liability exclusions, except for you can actually see how they're spelled out in the coverage form here, whereas you'll see the third one there is going to be the least auto exclusion there, but you'll see, again, the loophole that it gives it back if the auto's in for repairs. And then, again, the total racing exclusion. One I'd like to talk, well, again, the false pretense coverage, but that can be bought back for an additional premium. Now, number 6, though, you'll see, now this is basically we understand that dealers from the point of purchase they might go out of state for an auction, they might so it could take them time to get the auto back to their lot. So that's why this is in there, that it gives them coverage up to 45 days for a temporary location. So if they go to an auction and then on the way back they stop at a repair shop and leave their auto at a repair shop, maybe to get wrenched on and fixed in preparation for sale, takes a week to get back to the lot. Well, that's okay. I mean, like I said, the policy gives that up to 45 days for temporary location. Limits of insurance. So this point of this slide is really to let you know that the insured can't be, they can't really profit from a loss. So in the event of a total loss, they're not going to get their retail value for it. It's going to basically be our claims department's they'll do their valuation and they're going to give the actual cash value or what the auto is worth at the time of the loss. So now if you have like a restored auto that they put some, additional parts or some high performance parts, that type of thing, they will take that into consideration as long as they have record for it, and things like that. So, but I think number 4 is very important on this slide. So the 100% coinsurance clause. So let me spend a little time on this one. So the dealer's open lot, or again, the physical damage of the owned autos, can be, most companies offer it on a non-reporting basis. Some will do it on a monthly or quarterly reporting basis, which can be very, there's high maintenance with those, so we do not offer that. That's because then you have every month or every quarter you have to get another update of what their inventory is, and then you have to amend the policy based on their new limit and charge them the additional or return premium. So we do what's called a non-reporting, and most carriers will do the same. And this is just, we want to know what the most that dealer, because we understand, again, that dealers, their inventory is going to fluctuate. They might have certain times of the year, they might have more than others. They might, it's going to fluctuate based on busier times and not. Anyway, so we do what's called a non-reporting basis. So we want to know what the most inventory they're going to have at any given time of the year is. And we're going to charge based on that exposure. So if they're not, the 100% coinsurance clause comes into play in the event of a loss, though. So what happens in a loss is that our claims department, if physical damage loss happens to an owned auto, claims department's going to contact the insured and ask them, hey, well, we need an inventory amount. And sometimes they'll ask for a full inventory list with the values on there. So if our insured is under, if they're not insured to the value where they should be, so let's just say, for instance, they should have, we'll make the numbers easy. Let's just say they should have been insured, they had $100,000 of inventory on their lot, but on the time of the loss, but we're only insuring them for $50,000. That's all they told us that they would have. Well, so you can see, to make it the number simple, you can see that they're 50% underinsured. So what happens is they're only going to be paid for 50% of that loss minus the deductible. So they might save a few $100s they might have saved up front on the premium, but if they had a $50,000 loss, now they're only going to get $25,000 payout. So as you can see, it can be very significant on the back end of a loss versus the front end savings on the little bit of premium they save. So just very important that they understand the 100% co-insurance clause, how it applies, how it works, and that they're adequately insured, so they don't suffer that type of penalty.
And just a reminder, please get your questions in because we're going to be coming to a close shortly.
And key rating factors. So what you're probably used to on a commercial general liability form is, rating based on sales or payroll. Well, garage form is different in the fact that where a service risk is only rated on employees, whether or not they're full-time or part-time. Well, dealers are a little more complicated because there's a lot more exposure involved. So there's what's called the furnished driver, as you see there. So furnished driver is personal use of an owned auto. So we understand one of the perks a lot of dealers will do is, they'll drive a company auto, an owned auto, or they'll give their spouse an auto to drive, or even their top salesperson as a perk. So we understand that. But due to the added exposure, we charge a little more premium for that. So that's what's called a furnished driver. So again, you'll have some furnished drivers, and dealer ratings are also based on full-time, part-time, of course, and then if they're furnished or not, and then also how much, if they have any auto exposure. So if they have, if they have any driving exposure at all, if it's just a detailer on the lot that never picks up an auto, he's going to be rated for differently than a guy who is a sales guy who's always out test driving autos, things like that. So now, number of dealer plates here, that's important too, because again, that goes back to who's driving the autos, because anyone who's on a furnished auto is going to be driving with a dealer plate attached to it. So if you have, a key thing to look for is the employee to plate ratio. So if you have we start getting concerned when the ratio from the employee to plate ratio is more than 1 to 3. So if you start having, you got a guy with 20 dealer plates and it's a two-man operation, well, you're going to question, well, what's going on with all these other dealer plates? Because someone's probably driving on these. You probably got some family members or so it's just non-reported drivers that are driving on these that you don't know about, that you probably want to know about, underwrite for, charge the premium for, obtain their MVRs, etc. So again, that's very important in that aspect. Another thing I just wanted to touch on too, that before we moved on, is that the application for garage, we do require a separate application for garage risk, just because there's just so much. It's just a different risk, so there's so much more information. So to prevent back and forth between you and your general agent or your broker, that we get the garage application up front, gives us most of the information we need. And then also there's even supplemental ads for different classes, because again, there's just additional questions. So for like instance of valet risk or a heavy truck repair risk, there's just additional questions. So there may be supplemental applications that to prevent back and forth, and we could try to get the quote out as soon as possible. One last thing I wanted to add too, before we end it and get to any questions, should you have them, we can also add property onto a garage policy. So whether if they want the building covered or their business personal property or business income, we even have the ability to add in the marine if they have mobile tools that they need covered, that type of risk for a mobile operation. So anyway, that's kind of, I know it's a lot of information, kind of garage in a nutshell. So yes, I do encourage
Ronaldo,
if you guys do have any.
One. Yeah,
sure.
Ronaldo, we have one question regarding a more in-depth definition of dealer plates, and if you want to talk a little bit more on dealer plates.
Sure.
Angela
sure.
and Angelica, I'm not sure exactly what your question is, but we will go over dealer plates again.
Yeah, so dealer plates, basically, most dealers, like you'll see, again, okay, I guess I'll start like this. So dealer plates, again, we get concerned when all dealers, they have to apply for these dealer plates. So any dealer is going to have some dealer plates, because again, when they test drive an auto, all the autos on the lot do not have a plate on them. So when they go and test drive an auto, they'll put a dealer plate on it, and now they can go on the road and test drive it. And again, the dealer plate also goes on, they'll use them for furnished autos because they're going to use these for personal use. So they'll take an inventoried auto that's on the lot for sale, and they'll give it to their spouse or, again, a top salesperson or whatnot, and say, hey, here, you can go ahead and drive this. Again, it's a perk for working here. You're a top performer, or you're my wife, and you're going to drive this. You can have this car. So again, but since these inventoried vehicles on the lot do not have a plate on them, they have to put a dealer plate on to make them so they can drive them on the road. But again, we get concerned whenever you start having whenever you have dealer plates. And so how we look at it is it's a 2-to-1 ratio makes perfect sense, right? Because then you have the guy who could be furnished, and I'm talking employee to plate ratio. So 2-to-1 makes perfect sense because you got a guy who could be furnished, and then one who could be on a test drive, so he could go on a test drive as well, right? But then again, when you start getting 3-to-1 ratio, you start questioning things and saying, hey, like, what are these plates being used for? Like, is there something we don't know about here? Is there a driver or that we don't know about? So it's just
right.
something.
And the main purpose here is looking for the exposure. And what Ronaldo's saying is absolutely correct. It's the ratio. And when we look at the ratio, when the ratio is out of whack, we get concerned about what the exposure is that wasn't brought to our attention. And so that may cause Teresa to come back and ask some additional questions from you in getting a better understanding of why the ratio does not look accurate.
Right. I'm going to start questioning, are we missing some employees that I don't know about? It goes right back to the number of workers.
Correct.
And it could be a situation, like there's situations too that make perfect sense though, because we've had, there's always situations where they downsize. Say you had a large dealer and then they downsize, but they don't want to give their plates back. So sometimes it makes sense, but then again, we just need those answers. So it's just questions, and if we get an answer that makes us comfortable with the ratio, we can move forward with it. But again, it is a concern that you just want to question.
Right. And Angelica, you are correct. On a dealer, the intention of the dealer plate is for their vehicle, and they're going to put a dealer plate on when they take a customer out to test drive. But the owner of the dealership may also be using that vehicle for personal use, or a spouse might be using it, or like Ronaldo said, as a perk to one of their top salesmen. That so the dealer plate is interchangeable amongst the inventory that the dealer has at the time. So if the owner wants to drive a Cadillac today and drive a Corvette tomorrow, then that's how it works.
Yeah, I guess I should have clarified. Yeah, it's not tied to any like certain vehicle, like a regular, like your plate would for your personal auto. So I guess I should have clarified that. Dealer plate, they can basically put it on any of their owned autos and in the inventory, and then they can drive it on on the road. So like I said, for a test drive, or like she said that if they want to drive a different car tomorrow in their inventory, they can put it on one and take it home, and it's their. So yeah, it's not tied to a specific auto like a regular personal plate.
Right. Annie, I'm going to come back to your question because I want to stay on the dealer plate topic real quick. But we have a question coming in from Lisa asking, what is the concern with transporter plates versus dealer plates?
So a transporter plate, okay, that's a good question. And now a dealer plate, it's not tied to any specific auto, but it is tied to that. It still has to be an inventoried auto, though, to be now if they were to get pulled over and this is like an auto that's not an inventoried auto, they could get in trouble for that, just like anyone, get a citation ticket. Now a transporter plate, though, they can slap that on any auto, though, and they will, and now we're on the hook for it. So that really there is much more exposure with that. Now you don't really see those with dealers. You'll typically see them with salvage yards because they'll go get an abandoned vehicle that's not owned by anybody. So to get it back to their lot, they'll slap the transporter plate on it and bring it back. So you don't typically see it with dealers. And again, it's going to be more for like your service risks. If you do see it with a dealer, you want to question and say, hey, is this a true transporter plate or is this a dealer plate you're referring to? And if they have a transporter plate, why do you have one, or what's it being used for?
Right. Annie, to get to your question regarding mobile auto repair and or detailing, I did want to speak a little bit, as Teresa as well, on the different types of risk exposures that we're looking for that may vary from the standard markets or direct appointments that you have. We really are trying to be a full service garage underwriter for you. So that the different types of risks that we look at can range from your simple auto service repair risk and or dealer to heavy truck repair, to mobile service, to valet. And those are all taken into account on our application, and then potentially with some of your higher exposure, maybe a tire dealer or a heavy truck repair business may have a supplemental application tied to it. So Teresa really is looking for all types of automotive service, repair, and dealer risks, including motorcycles, could be tractors and heavy truck. Mobile services are ones that we are also involved in, as well as the detailing services. So your car washes, personal detailers, mobile detailers are also something that we definitely consider. There's a question coming from Joseph about discuss what is done during an audit. This garage form is not auditable. So
that's correct. Yeah, we don't.
One of the values here is the rating on number of employees. And with any insurance policy that is sold, a lot of it is done based off of the knowledge that we learn from you as our agents. So because this is an employee-rated policy, you will find often that we are doing an inspection on the risk, but we will not be auditing the risk. So, we are looking to confirm that the number of employees that they have on a full-time or part-time basis are accounted for accurately, and that the policy is rated for accurately based off the exposures of the risk, which we find at the inception of the policy instead of waiting a year and then tacking on additional premium at the end and finding out that nope, they had a huge amount of growth and their sales went from $100,000 to $500,000, and now you're getting stuck with a $5,000 audit. So we do an extensive amount of underwriting on the front side, which then allows us to get through the policy term, and one of the conveniences is no audit on the back side.
That's correct. And I would like to add too, it is important though that they are made aware that the insureds know that, if they do add or even delete staff, that, to make us aware so we can get the policy amended accordingly too. So, because they may get return premium, but if not, we got to add them, there'd be an additional premium with that. So.
Right. Okay. So with regards to the co-insurance and using non-round numbers is the question. So an inventory of 200,000, but we only have 75,000 in coverage. So what you have to do in the situation is look at what the percentage that they are underinsured. And
right. I'm sorry. Go ahead.
No, go ahead, Ronaldo.
I was just going to say that there's an easy formula that we used to use in claims, and it's basically what they did, so the limit they did over the limit they should have done, times the loss minus the deductible. So that's going to be the payoff of the loss. So in your situation, if they should have or they did, they should have had 200,000 over the 70,000, so yeah, it's did over should, and then I said that backwards, but it's did over should.
Right.
Times the loss minus the deductible. So that's how you calculate it.
Right. So they had 75,000 in coverage. They should have had 200,000 in coverage. So they're short by 125,000.
Right. Yeah. So in that case, I think they'd be. Yeah, that's a significant. See, in that case, that'd be such a significant co-insurance penalty. Again, that it's just important that they know they might save a few $100s on the front end of the premium, but that could be a significant, loss on the payout on the back end.
Right. These are really good questions coming in regarding dealer plates, and I'm glad the questions are being asked. So this one, how long can a family member keep a dealer plate? Is there a time limit? And the answer is no. What the exposure that we're looking for is to know who has access to the dealer plate so that we're rating for that as a furnished driver appropriately. The intention is not to, have your brother, sister, and mother come and grab a car off of the lot anytime that they want to. The driving exposure still exists with the dealer plate anytime there's a furnished auto, and we need to make sure that we're rating for the furnished auto appropriately. And so as far as a time limit, it's there. As long as the individual is rated as a furnished driver, then there is no amount of time in which that person, it doesn't expire.
That's correct. Now there's certain situations where you may have a driver's certain carriers like we do, like if you're under 21 or if you're over 79, you may require some additional documents like a medical examination for the guy over 79 that's furnished, or under 21 where you'd require an MVR every year, but that type of thing. But yes, to answer your question, she's correct, absolutely correct.
Do we offer transporter plate coverage for, let's say, an automotive transport company?
Well, so an auto transport company, I guess that to me is more of a, I guess it depends on the risk. But so to answer your question, we do offer transporter plate coverage, but it depends on the risk, whether or not we want the risk or not. So the auto transport risk to me is more of a commercial transportation coverage, or belongs more of a transportation policy versus a garage policy, just because there's real, it's more of a commercial transportation exposure.
Correct.
But yeah, to answer your first part of the question, yeah, we do offer transporter plate coverage. We do limit the liability to $100,000 though with that, and we do. It is a hefty premium what we charge for them. I think it's roughly like $1,000 a plate. So because of the added exposure with it.
Okay. Angelica, does the vehicle have to be for sale in order to have dealer plates? The vehicle has to be in the dealer's inventory and owned by the dealership in order for it to be eligible to put the dealer plate on it.
That's correct, because if it's not part of the inventory, then it really should have its own plate registered to the company, which would be more of like because you'll see, like I said earlier, we have the ability to schedule autos. So if they had like a parts vehicle that was not part of the inventory, let's just say that they it was registered to the dealership, but it's not for sale. They just use it to run errands with it. So yeah, so that would not have a dealer plate on it. That would have its own plate that was registered to the company.
Right. Well, we'll give it a couple more seconds here and see if we have any more questions coming in. I hope that we ended up answering everybody's questions, and they were excellent questions. I appreciate that. All right, we are going to conclude today's session. An audio version of the Garage Insurance Made Easy webinar will be posted on our website. Please feel free to refer back to the recorded session at any time or share it with others in your office. If you have any questions regarding coverage, types of risks that we're looking for, please feel free to reach out to Teresa, and she will direct you with the appropriate application, take you to our website. If you're looking for any more one-on-one type training, we are also open to doing additional webinars with you and your office, and we can schedule those with you separately. There will be a short survey that follows, and we would appreciate you taking the time to participate in the survey, and we greatly value your feedback. Last, you're going to be receiving an email from Teresa with our Automotive Service Operations Marketing piece. You can see it here on the last slide. This is a piece that's designed for you to customize with your agency information and use it with your prospective clients. Keep an eye on your email for upcoming month's webinars, and feel free to register for any of the offerings that we have going forward. Teresa and I both want to thank you for joining today. Ronaldo, thank you for your time in speaking with all of our retail brokers. We greatly appreciate that. We hope that everyone found value in our webinar, and we really look forward to underwriting your garage submissions in the future.
Thank you so much. Have a great day.
Thank you, everyone.